Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer. The show where we cover foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jonathan, Media Production Specialist here at Strategic Treasurer, so sit back, relax, and enjoy the show. We are back with another coffee break session. Craig, welcome back to the show.
It seems like I was just here talking about Ray Rock last time. It's good to be back, though.
Today, I wanted you to answer, what is OCI or OCI?
Nobody calls it OCI. I don't think that's going to pick up, but OCI stands for Other Comprehensive Income.
Okay.
And this is a shout out to the accountants of the world. It's a pretty interesting term. Not everybody in Treasury loves it or wants to talk about it, but there are some implications for it. So it's Other Comprehensive Income, or OCI.
Have you categorized your OCI yet?
No.
So how does it differ from net income in a financial statement?
As a formally trained accountant, we're allowed to make fun of accounting. And so I'll do a little bit of that. And there's some reasons for it. So all the accounting majors who love it and are going to get upset by what I say, don't take it too seriously. If you're not upset, take it seriously. How about that? So it differs from net income. Other comprehensive is a balance sheet item. It's described as income, but it's on the balance sheet, not on the income statement. So if we think of statement of cash flows, income statement, balance sheet, we think of the three primary financial statements, so the three financial statements that accountants love, that financial people know how to read, and finance pros know how to pull apart and analyze an organization. So other comprehensive income is on the balance sheet. It's not on the income statement. That should spur a few more questions.
Yeah, can you give me a line item that would qualify for that?
So from a treasurer perspective, one of the things that would flow into it, if you have an effective hedge, you have a financial instrument that's offsetting some type of exposure you have, could be FX or interest rate. I'm not speaking 100% accurately, but here's the concept. To the extent that the hedge is effective, you can roll some of that through other comprehensive income. Maybe I should take a step back on this to explain it. There's an accounting and then there's an economic aspect to, let's say you put a hedge in place. You put a hedge in place because you want to reduce, as a normal company, not as a hedge fund, but as a normal company, when you hedge something, you're trying to reduce the volatility. Typically, you're trying to reduce volatility, bring volatility that you could experience in line with what your capacity is, what your appetite is, what you're trying to accomplish. You're trying to reduce volatility to what you can live with. And so that's the economic model. And so you put a hedge in place. Let's say you have floating interest rates. And so you put a interest rate swap. You swap the floating aspect to something that's fixed. So you still have your underlying loan that's floating and you have a fixed floating to fixed interest rate derivative. So, if your interest rates go up on the underlying exposure, your financial instrument moves in the other direction. So it wipes it out or wipes out a significant percentage of it. We speak about that as effectiveness. You're trying to economically smooth things out. On the accounting side, if it's treated as non-effective, all of that, the volatility that may change, let's say one quarter to another quarter, has to flow through to the income statement right away. Even though economically over time it makes good sense, it's very effective economically, all of it will flow to the income statement immediately, creating volatility that you're trying to avoid. And so if you can run it through OCI, you can run most of the volatility. It goes into OCI, which is a balance sheet item, and then it's released from OCI into the income statement according to a number of schedule. That's much more involved, but it'll get released over time, like it'll flow out of OCI into the income statement over time, reducing the volatility you see in your financial statements. And so there's an economic aspect, which is what finance would care about mostly. Accounting is supposed to report it, but accounting, because of these rules, you can have it create an economic feedback loop. If you have great volatility, people consider your organization more risky, and that creates a feedback for share price, for example. And so the idea of we can run it through OCI, release it gradually, is saying, hey, this is effective. It's going to tie up with this, over time, matching the economic model. If it's ineffective, or the portion of ineffectiveness will flow directly to the income statement. So now we have this great volatility on our financial statements, which many people would argue is not really true financial volatility. It's just because it's not a certain level of effectiveness, it's considered, let's put it all through. And so now you have this accounting reporting process that creates and shows and reflects significant volatility on the financial statement as opposed to just the economic side. And that's the area of battle there. How it depends on how effective it is. But other comprehensive is a way of store it up here, release it over time. There's quite a few factors of how it's released, but it's released over time, creates stable financial statements. So if you have good economics, it's fully effective. It goes through, it flows through OCI in the balance sheet, gets released from the balance sheet to the income statement over the respective period of times. That can be very smooth, but once you start falling out of effectiveness, it hits your income statement much more rapidly.
So the main purpose would be masking volatility?
The main purpose of OCI, I would say, from a hedge perspective, is to make it so that the financial reporting lines up with the economic reality. Once it falls outside the range, the accounting world says that it's ineffective. Therefore, since it's ineffective, you can't treat it as smooth economically. You have to treat it as this income variation happens in the period that it occurs. And so that fits with some of the accounting principles, but there's some cases where it falls outside those lines, and that's where people would challenge what the accountants think on that. But for the most part, there's certain levels, 125%, 80%. When it falls outside those ranges, everything flows right through to the income statement. It's an immediate pass through. There's no holding tank. Just like on your, you build a new property here, you have to put certain retention ponds so that the water doesn't just flow off your property right into the lake or the reservoir. It goes into a pond and gets released slowly. That's the other comprehensive bucket on the balance sheet. But if it flows right through to the pond, that would be the, hey, it's ineffective. Everything goes immediately to the income statement.
Does this flow down and affect tax as well?
Yeah, because I hadn't really thought about that, but certainly because there's an impact on income, on how that flows. There's going to be an impact on taxes between periods, at least.
Okay. And for Treasury, why is this important?
Well, it's important because Treasury is focused on the economic stability. That you hedge to provide consistency, or you hedge to reduce volatility. And you want to reduce volatility economically, but there's an aspect of you want it to be reduced from an accounting perspective as well. Smooth is better than lumpy and jagged. And so it matters because your hedges should be effective. That's a better economic model. But there's also certain points, the less effective it is, the more it's going to have that feedback loop on the income statement of quarter to quarter volatility. So it matters for that because you're trying to smooth both of those things out.
Can it change your strategy?
Yeah, some organizations are like, we're not even going to try for hedge accounting. We're just going to hedge. We're just going to do the economic hedge. Everything will flow to the income statement right away, and that's fine. We're just going to do the hedge, and so some people do that
for simplicity, or
for simplicity and for tracking and managing. Others are, we're going to do it. We'll either have the expertise in house. We'll use a third party to help manage that because we do want to qualify for hedge accounting. We do want to use hedge accounting, and therefore we'll use tools and third-party services to support that and make sure that our hedges are as effective as possible.
So this seems pretty in-depth. If someone's trying to get more info on this, what should they be looking for?
Well, I think they should look at hedge accounting. They want to understand hedge accounting at least at a certain level. What is it? How does it work? And there's quite a few blogs out there. I know we have some writing on it. There's the companies that focus on hedge accounting and risk management, both treasury systems as well as dedicated firms that just go in and do the hedge accounting, sometimes even the hedging for companies to manage it. So those are some sources to look at. I would look up treasury, hedge accounting services as one way of searching.
Cool. Well, thanks. And to our listeners, remember to tune back every first and third Thursday of the month for another coffee break session.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.